Your 401k statement shows a growing number. You feel fine. But what your statement cannot show you, what it is structurally designed not to show, in plain dollars, is the other pile. The pile that grew right alongside yours, pulled directly from your account, compounding against you the same way your principal compounds for you across all 401k plans in America as of the end of 2024. That other pile, the fee pile, is running at roughly $46 billion a year, drawn from $8.9 trillion in total 401k assets, at an average total plan cost of about 0.52%. That is the number the industry talks about in conference rooms. Your HR department does not put it on a slide. And here is what makes this genuinely strange. Average mutual fund expense ratios in 401k plans are at historic lows, having fallen 66% over 24 years. From 0.76% in 2000 to 0.26% in 2024, so fees are lower than they have ever been. And yet, a US Government Accountability Office report found that 40% of participants don't understand 401k fee information, and 41% don't know they pay fees at all. Lower fees, less awareness. The gap between what the system charges and what people believe they pay has never been wider in dollar terms. This video is about exactly where the money goes. I'm going to walk you through 3 layers of cost inside your 401k. Most people only know one. The second is where the real money drains. And the third is where the industry has quietly built a system that works against you before you ever pick a fund. By the end of this, you'll know exactly what to look for, what questions to ask HR, and how to calculate the real damage in your own account. Let's start with the structure. Your 401k has a central metaphor that nobody teaches you up front. Your money is the property. The financial system collects rent on it every year. It collects rent in a bull market and in a bear market. The rent goes up as your balance grows because most fees are percentage-based. You never see the rent check. You only see the net. You are a landlord who has never read the lease. This is the frame. Hold on to it because I am going to keep coming back to it. In a few minutes, I am going to show you something that is hiding in the fund prospectus you have never read, something your record keeper actively benefits from keeping quiet. But first, let me explain the 3-layer structure, because most people walk into this conversation thinking there is one fee and there are actually 3, stacked inside each other like a Russian nesting doll. 401k fees fall into 3 basic categories, as defined by the US Department of Labor: investment fees, plan administration fees, and individual service fees. Layer 1 is what you have probably heard of. Investment fees, most often expressed as an expense ratio, which are the costs of managing the mutual funds or other investment options within your 401k. This is the number people quote at dinner parties when they say, "I only pay 0.25%. Fine, but that is layer 1 only. Administrators do not send you bills every year to demonstrate how much you are paying for plan management. They do not itemize fees on statements. Instead, fees are shown through the plan's reduced net returns. You never see a line item. You see a smaller number at the end of the year, and you assume it was the market. Layer 2 is the plan administration fee. The day-to-day operation of a 401k plan involves expenses for basic and necessary administrative services, record keeping, accounting, legal, and trustee services. A 401k plan also may offer additional services, such as telephone voice response systems, customer service representatives, educational seminars, retirement planning software, and online transactions. Somebody has to pay for all of that. These are often charged as a percentage of plan assets, meaning they grow as your account grows, even when the cost of service doesn't. Layer 3. This one is what I want you to pay attention to. Some mutual fund share classes rebate a portion of their investment expenses to 401k service providers, record keepers, and financial advisors to offset plan costs. This revenue sharing can create conflicts of interest that keep fund costs higher than necessary. This is called revenue sharing, and it is a completely legal, widespread, and structurally incentivized arrangement. Revenue sharing fees are baked into the expense ratio of an investment and are used to pay a third party, such as a record keeper or advisor. These fees may be tucked away in fee disclosure documents that can be complicated to understand without a financial advisor. They may often be overlooked because they're factored into the share costs. Think about that. The fee exists inside the fee. Rent on your own money hidden inside the advertised rent. Now here is where the numbers start to matter. According to the 2025 ICI study, the average 401k equity mutual fund expense ratio was 0.26% in 2024. But expense ratios are only one of at least 5 fee layers most participants pay. A 1% difference in annual fees costs approximately $469,000 over a 30-year career on a $200,000 portfolio with $10,000 in annual contributions. $469,000 gone. And that is only the difference from 1 percentage point. According to the 2025 edition of the 401k Averages book, a $5 million plan has average total costs of 1.08%, including 0.37% in advisor compensation, while a $50 million plan costs 0.76%. Morningstar data shows the range stretches from 0.27% for plans above $1 billion to 1.26% for plans under $1 million. Translation: if you work for a small company, you are very likely on the expensive end of this range. If you work for a smaller company, you're likely paying a small plan premium that has nothing to do with the funds themselves. The average investment expense of plan assets for a 401k plan with 25 participants and $250,000 in total assets is 1.37%, inclusive of investment management fees, fund expense ratios, 12 bone fees, sub-transfer agent fees, contract charges, wrap and advisor fees, and any other asset-based charges. 1.37%, not 0.26. And that is rent on your own money before you have even picked a single fund. Stay with me, because this next part changes everything. The conflict of interest I just described is not accidental. It was designed. And understanding it changes how you see every fund menu your HR department has ever handed you. Here's how it works in practice. A record keeper can be paid directly by the plan sponsor for its services, or indirectly. Indirect payments occur in the form of rebates made by third-party mutual funds to the record keeper, what's called revenue sharing. About 54% of plans in one research sample use revenue sharing compensation for their record keepers. Now think about what happens next. The record keeper, who gets a cut of every fund's expense ratio, gets to decide which funds go on your menu. Or at least, the record keeper has significant influence over what the plan sponsor selects. And a 2025 study reported that participants in revenue sharing plans tend to face significantly higher fees, and that less transparent indirect payments may allow record keepers to receive additional compensation. Revenue sharing remains in use today as a method to pay record keepers and can distort investment menu decisions. The average deletion rate is around 20% for revenue sharing funds and 28% for non-revenue sharing funds, meaning funds that pay the record keeper are harder to kick off the menu. Revenue sharing funds are more likely to be added to the menu and are less likely to be deleted. Overall, revenue sharing plans are more expensive, as higher expense ratios are not offset by lower direct fees or by superior performance. You are not picking from the best available funds. You are picking from the funds that were willing to pay for the privilege of being offered to you. This is not a conspiracy. It is an incentive structure. The record keeper is not evil. It is following a completely rational business model. The problem is that the business model points in the opposite direction from your retirement. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. There is a story here. Think about a grocery store that lets food companies pay for shelf space. The cereal at eye level is not there because it is the most nutritious. It is there because the company paid the most for placement. You walk in, you see what is at eye level, and you grab it. That is your 401k menu. You are not shopping. You are selecting from pre-paid placements. And this goes some way toward explaining something that should be alarming. A study examining more than 58,000 401k plans found that more than 99% of all corporate 401k plans offered investors at least one fund that had a cheaper alternative that performed better over 3, 5, and 10 years. More than 94% of corporate 401k plans had at least 3 funds that underperformed cheaper alternatives during those time periods. More than 85% had at least 5 underperforming funds. More than 70% had at least 10 of these clunker funds when narrowing the performance window to a 3 and 5 year period. 99% of plans. That is not a few bad actors. That is the architecture of the system. Here's the part of this conversation that never makes it into the brochure your HR department prints in 14-point font and leaves in the break room. I spent years surrounded by accountants and fiscal lawyers running my own business, watching how money actually moves through institutional structures. And the thing that surprised me most was not that the system was expensive. I expected that. What surprised me was the specific mechanism. The fee is almost never charged explicitly. You never see an invoice. The money is extracted from your return before the return is reported to you. The rental income disappears before you ever knew it existed. I built a digital book called The Exit Code, 8 chapters of analysis, built on 50 years of retirement data. No filler, no opinion without a source, because I wanted to understand exactly how far this goes. One of the things I found is what I call the 4% trap. The standard advice max, your 401k, hold until 65, withdraw 4% a year, is built on assumptions from a 30-year-old academic paper. It does not account for the fee drag described in this video. It does not account for a forced exit from the workforce in your mid-50s. And it does not account for what I call the dynamic withdrawal method, which adjusts your distribution strategy based on actual market conditions rather than a fixed rate that was calibrated for a lower fee era. The math is not the same as it was in 1994. The rules that were written for that math do not automatically update themselves. The book also covers the 58% rule, the probability that you will exit the workforce involuntarily before you intended, and what buffer you need to build to absorb that shock before your compounding window closes. This is not motivational content. It is a mathematical framework that takes, I'll figure it out when I get there, and turns it into a specific date. You can find it through the link in the description. It costs less than dinner for 2, and it is the research I wish had existed when I first started looking at these numbers seriously. Now, back to the fund menu, because I want to show you the second layer of damage, which is not just paying more, but paying more to underperform. Here is the reversal. You think the problem is fees. The actual problem is that most people are in the wrong type of fund, which means they are paying higher fees and getting worse returns. These two things multiply each other. The S&P Dow Jones Indices SPIVA scorecard is the industry standard for benchmarking active versus passive performance. Over the 20-year period from 2005 to 2024, 94.1% of all domestic funds underperformed the S&P 1500 Composite Index. And of the 18 domestic fund categories, in only 2 categories, did less than 90% of the funds underperform their benchmark. 94% over 20 years. Over the 15-year period ending December 2024, there were no categories in which a majority of active managers outperformed. Not some categories. No categories, 0 out of 22. Active funds struggled mightily to beat their index fund counterparts over the past year, according to a Morningstar report. And that happened even amid market gyrations tied to tariffs and geopolitics, the kind of volatile periods during which active managers typically claim to outperform. Just 33% of actively managed mutual funds and exchange-traded funds had higher asset-weighted returns than their average index counterparts from July 2024 through June 24. 25 after accounting for investment fees. This is where it gets really interesting, because it connects to what I showed you earlier. The revenue sharing system preferentially places active funds on your menu. Active funds pay higher revenue sharing because they have more expense ratio room to work with. Index funds, which charge 0.05 to 0.10%, have almost nothing to share. Actively managed funds, charging 0.75 to 1.5%, have plenty. So the system steers you toward the type of fund that costs more and has a roughly 2 in 3 chance of underperforming the market over the long run. And you are paying for the privilege of that underperformance. Rent on your own money for a worse return. A quick note, there is a reason fund companies spend hundreds of millions of dollars on advertising past performance. A fund that beat the market for 3 years is a marketable product. The fact that as S&P's 2024 persistence scorecard shows the persistence of top quartile performance was less than what would be expected by chance, reinforcing that past success is a poor predictor of future results. That fact does not make it into the glossy insert your plan mails you at enrollment. Here is an imaginary exchange presented without comment. Why is this actively managed fund in our plan instead of a cheaper index fund? Because it has been performing well. For how long? 3 years. And statistically, silence. Then, the coffee in the break room is free, by the way. Now you are asking yourself, how much does this actually cost me in real numbers? Let me show you. Meet Marcus. Marcus is 42 years old. He works for a regional logistics company with about 30 employees. His 401k has $200,000 in it. He contributes $10,000 per year. He plans to retire at 65. He has been doing everything right by conventional standards. Contributing consistently, not touching it, not panicking during downturns. For a plan with 25 participants and $250,000 in assets, the average total investment expense is 1.37%, inclusive of investment management fees, fund expense ratios, 12 bone fees, sub-transfer agent fees, contract charges, wrap and advisor fees. Marcus is almost certainly in a plan in that range. He has never checked. Neither has anyone in his HR department, partly because many Americans are unaware of the fees they pay in their 401k accounts. Research shows a large percentage of people do not know what they are paying in fees, with many believing they pay none at all. While fee disclosures have improved, the information is often complex and buried in lengthy documents. So let us run the numbers for Marcus. Assume a 7% gross annual return, roughly the long-term historical average for a diversified equity portfolio. In his current plan, paying 1.37% in total fees, his effective net return is 5.63% annually. Over 23 years, starting with $200,000 and adding $10,000 per year at 5.63% net, Marcus arrives at 65 with approximately $1,150,000. Now give Marcus access to a low-cost index fund at 0.10% in total fees. His net return becomes 6.9% annually. Same gross return, same contributions, same discipline. 23 years. He arrives at 65 with approximately $1,450,000. The difference is $300,000. $300,000 that Marcus earned, that Marcus contributed, that Marcus waited 23 years to collect, gone to fees. And here is the quiet cruelty of it. The $300,000 that left Marcus's account did not evaporate. It moved. It went to the fund company, the record keeper, and the plan administrator. Marcus funded their retirement. Alongside his, now zoom out. The magic number Americans say they need to retire comfortably in 2026 is $1.46 million. That is $200,000 more than the figure from 2025, and the median retirement savings for those aged 55 to 64 is $185,000. The median person in pre-retirement age has $185,000. The number they think they need is $1.46 million. Marcus, after all his discipline, barely hits the target, and only if someone reroutes his fee structure. The average person, without that rerouting, is arriving at a completely different retirement than the one they assumed they were building. This is not a math problem. This is a structural problem that looks like a math problem, and the structure benefits from you not understanding that distinction. Here is how the system explains itself when cornered. A financial advisor will tell you that your plan's fees include valuable services, access to the investment platform, compliance testing, plan administration, customer support. And that is true. Those services exist. But when fees total 1.5% compared to 0.5%, that 1 percentage point difference cuts the ending balance by by nearly 28%, a shortfall that few participants anticipate when they sign up for their plan. Imagine going to a restaurant and being told your meal costs $40. You pay it, you enjoy the meal, you tip 20%, you leave satisfied. Now imagine discovering that the $40 meal actually had a 28% invisible surcharge that the restaurant applied after the bill, before you received it. And they used that money to pay the waiter that you also tipped. That is not entirely different from what is happening to you every year. Here is the second comedic cutaway I promised you. A plan sponsor at a small company calls his broker and asks why none of the cheap index funds are on the menu. The broker explains that the administrative costs of the plan are being covered through revenue sharing from the current funds. The sponsor says, "So the funds pay the record keeper?" The broker says, "Essentially." The sponsor says, "And my employees are paying the funds?" The broker says, "Through the expense ratio, yes." The sponsor says, "So my employees are paying for their own record keeping without knowing it?" There is a long pause. "Would you like me to email you a PDF?" Now let me finish Marcus's story. After years of contributing and not reading the fee disclosure document because it looked like terms and conditions and nobody reads terms and conditions, Marcus gets curious. He logs into his plan portal late one evening and requests the annual 40405 disclosure. He searches for the words charge and fee throughout the statement. He finds line items labeled asset charge, outsider provider charge, and fees, and connects the dots between the fees of the available investments and the funds he has chosen. Marcus has been in an actively managed mid-cap growth fund with an expense ratio of 1.18%, a bond fund with an expense ratio of 0.78%, and a target date fund. He did not choose these funds strategically. They were the default options at enrollment, and he never changed them. Many plans default to actively managed funds with expense ratios well above 1%, even though low-cost index funds are widely available for under 0.10%. Paying more for high-cost funds is worth it if they deliver higher returns net of fees, but studies show most don't over time. Marcus contacts HR. He asks about switching to the plan's index fund options. He learns his plan has a Vanguard S&P 500 index fund, sitting quietly in the menu at 0.03%. It has been there the entire time. Nobody told him. The enrollment paperwork defaulted him into the fund that was most prominently featured, which happened to be the actively managed one, which happened to pay the highest revenue share to the record keeper. Marcus moves his balance. He adjusts his contribution allocation. He does not change his contribution amount, his employer match, or his investment timeline. He changes one thing: the fund with the highest rent attached to it, $300,000. That is what that one change is worth over the remaining 23 years of his contribution window. This is how I want you to think about the practical action at the end of this video, not as something dramatic, but as something annoyingly simple, that the architecture of the system deprioritizes your learning until you go looking for it yourself. Here are the three things to do. Number one, pull your 40405 fee disclosure. Start by checking your annual 40405 fee disclosure statement to get a clear picture of what you're paying. It is legally required to exist. Your plan administrator must provide it. Search it for the words fee, charge, expense ratio, 12-bone, and sub-transfer agent. Add every percentage up. That is your total rent. Then compare it against your balance in dollar terms. Multiply your balance by the total percentage. That is your annual fee bill in dollars. Seeing it as a dollar amount rather than a decimal changes the psychology of the decision. If you have $50,000 in your 401k and your total fees are 1.2%, your annual cost is $600. Seeing the cost in dollars is often more motivating than looking at small percentages. Number two, find the index fund options in your plan. Look for terms like index, passive, or S&P 500 in your fund options. Focus on funds with expense ratios under 0.50%. For reference, the average expense ratio for equity mutual funds in 401k plans was 0.26% in 2024. Actively managed funds typically charge 0.75% or more, while passively managed index funds can cost as little as 0.05%. If your plan has no low-cost index options whatsoever, that is a conversation worth having with HR, because your employer has a legal obligation under ERISA to ensure your 401k fees are reasonable. Number 3, benchmark your plan against its own competitive alternatives. If you invested $10,000 per year over a 30-year career in a 401k with fees of 0.87% versus 3.56%, earning an 8% annualized rate of return, the account with the larger fee would be worth around $630,000, while the one with a smaller fee would be worth around $1,035,000. That is a $405,000 gap. And 3.56% is not a fictional number. The 401k Averages book revealed that total plan costs for a $1 million plan with 100 participants range from 0.87% to 3.56%. The high end of that range is a real plan someone is enrolled in right now. Now, a word about the broader picture that almost never gets said plainly. The financial industry has a spectacular incentive to keep this conversation technical. Basis points, expense ratios, revenue sharing arrangements, sub-transfer agent fees. The vocabulary is real, but the complexity is partly constructed. At the end of the chain, what is happening is straightforward. Your retirement account is being charged rent. The rent is taken before you see your return. The rent is calibrated as a percentage, which means it grows automatically as your account grows. And the mechanism that determines which funds are on your menu is influenced by which funds pay the most rent to the people who curate the menu. This is not a conspiracy. There are no villains sitting in a room laughing. The participants in this system are responding rationally to their incentives. The record keeper wants revenue. The fund company wants distribution. The plan sponsor wants administrative simplicity. And you want a retirement. 3 of those 4 goals are served well by the current structure. 1 is not. The common practice of covering plan expenses through revenue sharing embedded in fund fees is becoming less popular as excessive fee lawsuits targeting 401k plans continue to mount. In 2025 alone, there have already been 51 such lawsuits, surpassing the 47 filed in 2024 and the 43 in 2023. With scrutiny intensifying, plan sponsors are looking for alternatives to traditional revenue sharing. The system is slowly changing. Lawsuit pressure works where disclosure requirements did not. But the change is slow. And in the meantime, you have a specific dollar amount attached to your specific plan's fee structure. And that number compounds against you whether or not the system has reformed itself by the time you retire. I want to come back to where I started. Your 401k statement shows a number. It went up. You feel fine. Here is the full version of what I said at the top. The other pile, the rent pile, is roughly $46 billion a year across the system. That $46 billion is not an accounting abstraction. It is the difference between Marcus retiring at 65 with $1,150,000 or $1,450,000, multiplied by millions of Marcus equivalents across the country. And most of them will never know because they did not pull the 40405, did not search the document for the word charge, and did not notice that the index fund at 0.03% was sitting at the bottom of the fund menu, below the 6 actively managed options at the top. A FINRA Investor Education Foundation study found that investors with the lowest financial literacy scores pay fees more than 10 times higher than those with the highest literacy. 10 times. The knowledge gap is not educational. It is structural. The system is not designed to teach you this. And the one person with both the incentive and the access to teach you your plan's financial advisor is often taking 0.37% of your assets in advisor compensation just to maintain the current arrangement. I read the boring documents, the SEC filings, the 40405 disclosures, the ERISA compliance reports, not because I enjoy dense regulatory language, nobody enjoys dense regulatory language, but because the gap between what those documents say and what the brochure says is exactly where the real cost lives. And the real cost, compounded over your working years, is not a rounding error. It is a retirement. Lazy investing built more fortune than crypto memes. The fact that you can know all of this and still be in the wrong fund because the enrollment form defaulted you there 12 years ago, that is the part I find genuinely funny, in the way a slow motion car crash is funny from a safety